Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for giving us a few minutes of your time. We're going to go over a few of the topics that we covered in this week's investment allocation meeting. The three things that we're going to hit this week, we're going to talk about CDs and how interest rates can impact them. Certainly CDs as an asset class or an investment tool that kind of went by the wayside for about a decade, but have certainly become more of interest as of late. So just want to give a couple of our thoughts along those. We can talk about S&P 500 and take an updated look at the trend after we've had a rebound. Andrew will cover that, as well as the real estate market and some really interesting thoughts as it relates to the labor market. Two of our bigger things in the United States American economy and how they're tied together. So we'll kick right off with CDs and how interest rates impact them. So naturally, we had a really chappy 2022, and all of a sudden, CDs, an interest rate or a tool that had very low interest rates for a long time, have suddenly swelled up, often yielding above 4%. In our opinion, they have a role and they have a place, and there should be some exposure, whether it's CDs or a CD-like tool, in some short-term fixed preservation tools. But we're taking a look here at the Federal Reserve's target rate expectations over time. So back in the early 2000s, we had rates that were 5.5%, 6.5%. Before they dropped to what at the time was really historically low levels at 1% in the Greenspan era. Of course, we come back up right into 2007 before we collapse and have the better part of a decade at 0%. So very quickly last year, interest rates by the Federal Reserve go up to 4%. Now, CDs are very closely tied to this rate that the federal funds rate is set by the FOMC. The thing forecasted here from the different colored lines, the blue and the green, what that's showing you is both the FOMC, the group that sets those rates, and as well as the green, which is the market expectations. Both of those anticipate that rates will come down. This is the speed and the rate at which is going to be a big part of 2023 in that battle, whether the market is right that it's sooner or the Fed's right that it's later. In either case, just notice how they both project that rates will fall lower. Now, the implications there, the problem is if you get overexposed and have too much money piled into CDs, the risk is that you'll be able to reinvest, or the rate that you'll be able to apply that when that CD matures at 18 or 36 months, whatever it may be at a far different lower rate. That may or may not be the case, but that is certainly one of the risks. And so when we're looking at short-term instruments, we want to look at a bigger picture, not just the rate that we're getting, but the other types of risk, whether it be inflation risk, reinvestment risk, really take a look at the broader picture. All right, so that's enough on interest rates. You'll know I could spend the whole day on that, Andrew, but we'll pivot now and talk about the S&P 500. So move from cash to stocks and let you update us on trends.
Very good. So in the allocation meeting, we often will look at different views of the technicals of the market, looking at the different price charts. But sometimes it's good just to take a step back and try to strip as much of it down just to some simple moving averages. Here we just have a simple daily chart of the S&P on the left and a weekly chart on the right. And on the left, the first we have is the 200-day moving average. This is simply the average price over the last 200 days. And that's really been a key level of resistance all of last year. Each time we saw the market try to give a rebound, we'd see a run up to this average price over the last 200 days, and then sellers would step back in. And we saw the same thing on the weekly chart. If we look at the right with the 50-week moving average, which is pretty close to basically the average price over the last year, 52 weeks in a year, 50-week moving average. And we can see here also that when we would run up after these periods of selling, the market would find resistance at these key levels. And so these are what we want to start looking for the market to break above. On the daily, we actually are now back above that 200-day moving average. It's a very good sign. We're still a little bit below the 50-week on the weekly chart. So we'd like to see the market get back around 4,100. That would be a positive change in character. But these simple moving averages really can tell us where the dominant trend is of the market. For right now, the trend is lower. If we start seeing these levels break and the market move above them, then that would give us more evidence that we're starting to see a renewed uptrend in the market. So we're not quite there yet on the longer term weekly chart, but we are seeing good development on that shorter term daily chart. So that's enough for equities. Now we're going to move into some of the broader economic data, specifically the real estate market. The real estate market, as interest rates have gone higher, as that chart that Adam showed clearly illustrate, the rising interest rates have also taken mortgage rates higher. And that's really been putting a lot of pressure on the real estate market. We've seen actually 11 straight months of declining sales for existing homes for year over year. One of the largest declines that we've seen in quite a while. And while we often talk about real estate, it's not just in a bubble or in a vacuum. The real estate market has wide-reaching implications, specifically on the labor market. And that's what this chart here looks at. In the green bar, we have the expectations for new home sales, and we can see that it leads the labor market by roughly 6 months. And that's what we have on that black line at the bottom is the unemployed and marginally attached as a percent of the labor force. Essentially, there's one way to look at the labor market. And when we start seeing weakness in the real estate market, that's often been historically a good predictor of some weakness that we could foretell coming into the labor market. And so over the last year, we've really seen, again, the real estate market's taken a hit as rates go up, and we've seen less inventory come online for people to buy. And so expectations, as shown by that green line, have really come down. This now kind of tells us that we could maybe start seeing some softening in the labor market. The labor market's been extremely strong here recently, even though we've seen inflation hit the market, rising interest rates, volatility in the equity market. The labor market really has been much stronger than I believe that many economists had predicted. Now we could start seeing that potentially begin to roll over as the impact of not only just the mortgage market, the housing market, but we are starting to see an increase in layoffs in the technology space. And so I think this year is going to really be a key focus is how does the labor market handle some of these headwinds that may come into the economy this year, and then which sectors maybe are more immune to that, and maybe which ones are going to take a larger hit, and how we can adjust our portfolios accordingly to best prepare for these big macro changes that may be unfolding in 2023.
Well put, Andrew. And the little bit that I would reinforce and add to that, and just going to be repeating it many times through 2023, as we often do, is this difference between what we see in the economy and what we could see play out in financial markets. They're often going in different directions. So the really paradoxical or the irony here is that labor market deteriorating quickly could very well be just what the market needs to get a little shot in the arm. The Federal Reserve has been, like we just showed you earlier in the couple slides ago, there's a difference between how quickly the market thinks rates will come down and how quickly the Fed will. One of the things that we're looking for is the labor market to weaken. So invariably, a labor market weakness here in the housing will feed different sectors differently, but it could very well be a strong market. We don't know. The point is we want to keep an open mind into what direction the market could go. So with that, we do thank you for the few minutes that you give us. Please don't forget you have an opportunity to come see us for your complimentary Next Steps meeting. Whether or not you decide to work with us, we will give you something to consider for your financial journey. 800-928-4001 is the phone number, or feel free to scan the QR code and schedule electronically. So thank you so much. Have a great weekend.